Investing for the long term requires a thoughtful approach to selecting the right assets. Two of the most popular ETFs that offer broad exposure to the US stock market are the Vanguard S&P 500 ETF and the SPDR S&P 500 ETF Trust. In today's video we will discuss historical preferences of top investors, understanding VOO and SPY, performance, expense ratios, dividend reinvestment, holdings comparison, summary for the compared ETFs. Both of these ETFs track the S&P 500 index, which consists of 500 of the largest publicly traded companies in the United States. Despite their similarities, there are key differences between VOO and SPY that long-term investors should consider. I will delve into these differences, exploring aspects such as expense ratios, fund structure, performance, liquidity, and historical preferences of renowned investors like Warren Buffett and John Bogle. Historical preferences of top investors. Warren Buffett, the legendary investor, has long advocated for low-cost S&P 500 index funds. He believes that most investors are better off investing in a diversified portfolio of large-cap US stocks rather than trying to pick individual winners.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time.
Buffett's preference aligns well with both VOO and SPY. However, given his emphasis on minimizing costs, VOO's lower expense ratio might make it a slightly more attractive option in his view. John Bogle, the founder of Vanguard and a pioneer of index investing, championed the idea of low-cost passive investing. His philosophy is embodied in VOO, which is designed to provide broad market exposure at a minimum cost. Bogle's principles of simplicity and cost efficiency make VOO an ideal choice for long-term investors seeking to follow his advice.
Don't peak. Just put your money away month after month after month after month, and don't look. And if you start when you're 20 and retire when you're 80, which I'm thinking about doing but haven't decided to do it yet, and you see what that account is worth in 60 years, you aren't going to believe it.
Understanding VOO and SPY. The Vanguard S&P 500 ETF ticker VOO was launched on September 9, 2010. Managed by Vanguard, one of the largest asset management companies in the world, VOO aims to replicate the performance of the S&P 500 index. Vanguard is known for its commitment to low-cost investing, a philosophy that is clearly reflected in VOO's expense ratio. The SPDR S&P 500 ETF Trust, ticker SPY, launched on January 22, 1993, is the first and one of the largest ETFs ever created. Managed by State Street Global Advisors, SPY also aims to track the performance of the S&P 500 index. SPY's longevity and size have made it a benchmark in the ETF industry. Performance. Both VOO and SPY aim to replicate the performance of the S&P 500 index, therefore their performance is typically very similar. However, the slight differences in expense ratios and fund structure can lead to minor variations over time. Historical performance. Over the past decade, VOO and SPY have delivered returns that closely mirror the S&P 500 index. Any performance differences are usually minor and often temporary. For example, VOO's lower expense ratio gives it a slight edge in the net returns, which can compound over long periods. In a direct comparison, VOO might outpace SPY by a small margin due to its lower costs. Expense ratios. One of the most critical factors for long-term investors is the cost associated with their investments. Both VOO and SPY have low expense ratios, but VOO holds a slight advantage in this regard. VOO's expense ratio. VOO boasts an expense ratio of 0.03%, one of the lowest in the industry. This low fee structure is part of Vanguard's broader commitments to reducing costs for investors.
Jack Bogle has done more for American investors than any other person connected with Wall Street or the investment process, because he with a number of other people, he came up with the idea of the index fund. He wasn't the sole thinker behind it, but he was the guy that implemented it and crusaded for it. But now there's trillions of dollars in low-cost index funds. Those people are going to have better lives, they're going to have better retirements, their kids are going to inherit more money because of Jack Bogle and his efforts.
Over the long term, lower expenses can significantly enhance net returns, particularly through the power of compounding. VOO's net assets stand at $533 billion. SPY's expense ratio. SPY has an expense ratio of 0.09%. While this is still relatively low, it's 3 times higher than that of VOO. For short-term investors, this difference might seem insignificant. However, for long-term investors, even small differences in expense ratios can add up to substantial amounts over decades. SPY has a significantly larger net asset base, with assets totaling $1.14 trillion. Dividend Reinvestment. Dividends are a critical component of total returns, especially for long-term investors. VOO pays dividends quarterly, and investors can choose to reinvest these dividends automatically. This reinvestment option is beneficial for compounding returns over time. VOO's dividend yield is 1.28% with a dividend growth rate of 5.81%. SPY also pays dividends quarterly. However, due to its UIT structure, SPY holds dividends in cash until they are paid out. While investors can manually reinvest these dividends, the delay can result in a slight performance drag compared to ETFs that reinvest dividends immediately. SPY's dividend yield is 1.26% with a dividend growth rate of 4.92%. Holdings comparison. The holdings of VOO and SPY are quite similar, reflecting their shared goal of replicating the S&P 500 index. However, there are some differences in their top allocations and weightings. Both ETFs have significant investments in major technology companies like Microsoft, Apple and Nvidia. VOO's top holding is Microsoft Corporation with a weight of 6.96%, closely followed by Apple Inc. at 6.30% and Nvidia Corporation at 6.11%. In contrast, SPY allocates a slightly higher percentage to Microsoft at 7.19% and Nvidia at 7.01%, while Apple stands at 6.61%. SPY also includes Broadcom Inc. 1.66% in its top 10 holdings, whereas VOO does not, and VOO features JP Morgan Chase & Co. 1.32%, which is absent from SPY's top allocations. What is the summary for the compared ETFs? VOO and SPY are both excellent choices for long-term investors seeking exposure to the S&P 500 index. While they share many similarities, there are key differences that can impact an investor's decision. VOO's lower expense ratio, mutual fund corporation structure and slight tax efficiency edge make it a strong contender for cost-conscious long-term investors. SPY's unparalleled liquidity, established history and tight bid-ask spreads make it an attractive option for those who prioritize trading flexibility and liquidity. Ultimately, the choice between VOO and SPY should be based on individual investment goals, cost sensitivity, trading habits and tax considerations. Both ETFs offer robust, diversified exposure to the US stock market, making them solid building blocks for a long-term investment portfolio. Thanks so much for watching the video. If you learned something interesting, give the video a like and subscribe so you don't miss any of my other videos. Have fun and invest wisely.